Coming up in this week's episode, we'll be taking a look at this week's lender rate and criteria changes. We'll be taking a look at the latest swap rate chart. We're also going to be taking a look at the latest jobs data, the latest mortgage and arrears data, this month's GDP data, and the latest RIGS residential market survey. Hello everybody and welcome to this week's UK Mortgage Market Insights for the week ending the 15th of March 2024. I hope you're all well. So first up this week, we'll take a look at the latest jobs data that's covered off in the ONS's Labour Market Review for March 2024. Quite a lot of information in here. There will be a link to the article below, but if I can just cover off the key points for you. So this month's data shows that the annual growth in regular pay, excluding bonuses, was 6.1% in the 3 months to the end of January. That's slightly lower than the 3 months to the end of December, which was 6.2%. But obviously, with inflation heading down towards target of 2%, this clearly showed that wage increases, despite the slight drop, are still outstripping inflation. The report also revealed that the UK unemployment was at 3.9% in the 3 months to January, which was slightly up on the previous 3 months at 3.8%. Despite this slight rise in unemployment, it is sitting at historically low levels. Now, the government have been trying to promote this week, saying that everything's looking positive, that wages are on the increase, unemployment is on the way down. But to me, this data is a little bit misleading, and there is a lot of confusion in the numbers that the government are presenting to us, because the way that I see it is that people are genuinely struggling to pay their bills, to pay their mortgage at these increased rates. Food bank use is at an all-time high, yet apparently inflation's on the way down, it's nearly at target, and we should all be feeling better off because wages have risen. So what's going on? I think one place to look is the way that the inflation numbers are presented to us, because the one key thing that isn't mentioned is owner-occupied housing costs when it comes to declaring what the inflation rate is. They don't include the single biggest cost that a household faces, and that's its mortgage or its rent. And we all know that because of the higher interest rate environment that we're currently finding ourselves in, these payments have gone up exponentially over the last year or so. So why don't the government change the way that they present this data and include this in the real inflation number? To me, not including it completely skews the data, because we all know that it does feel quite tough out there despite what the government are saying. So please let me know in the comments below, how does the economy feel to you? Are you struggling or are you finding things okay? And what about those around you, friends and family? How are they finding things? Please do let me know in the comments below. I'd be interested to get your thoughts. Next up, I'd like to take a look at the lender rate changes that we've seen this week. So NatWest have made slight increases for existing customers on their residential and buy-to-let product. Santander are increasing fixed and tracker rate products for new business and product transfers, but they're reducing selected fixed rates for residential remortgages and all their buy-to-let fixed rates. Co-op are making increases to their 2 and 5 year fixed rates by up to 0.22%, but they're making very slight reductions on their 3-year fixed rate. Generation Home going against the grain, and they're making rate reductions of up to 0.25% on some of their products. Halifax are increasing rates on selected 2 and 5 year product, and also for the second time this week, they announced further increases on their 2-year fixed rates. Clearly, the 2-year fixed rate is a popular product, and lenders seem to be trying to cash in on this. Landbay, 5-year fixed rates up by 0.25% for small HMO and multi-unit freehold block applications. Fleet are making slight increases to some of their 5-year fixed rates, and Mansfield Building Society are making slight reductions on their credit repair mortgages, so looking to help people that need a little bit of help. Skipton are making increases across selected 2 and 5-year fixed rate product, and the Mortgage Works are making rate increases on selected switcher products. Coventry, hooray, we love the Coventry, because they're making reductions across the board on all their new borrower products, and West One are making some rate reductions as well. And lastly, Kent Reliance reducing their 80% loan-to-value rate for buy-to-let, and they're reducing their 85 and 90% loan-to-value rates for residential. So a bit of a mixed bag. Some key highlights because a couple of lenders there are actually reducing rates, which is great news. So next, let's take a look at the criteria changes that we've seen this week. So first up, Accord. They've made some changes to their interest-only mortgage when the repayment method is the sale of the mortgaged property. This policy update means that potentially more people will now meet this repayment method criteria and can use this mortgage option. Halifax this week made some changes which hit the news, and in my opinion, whilst I understand why they're doing it, I don't think it's the right timing. They've basically made some reductions to the maximum working age, reducing it from 75 to 70, where not so many months ago they actually increased it from 70 to 75. Essentially, this is when people are applying for a mortgage and they're saying that they're going to continue to work until age 70 or 75. Many lenders will allow people to go up to 80, and obviously this is quite risky. How many people are going to be working at this stage in life? But it is something that we're seeing more and more these days. So Halifax, in my opinion, made a boo-boo. They've basically turned around and said, our maximum working age age is now 70, not 75, and this takes effect for certain mortgage customers. So at the point of remortgage, if you've got a low credit score or your overall credit profile doesn't suit, then they're going to take your maximum working age as 70. And additionally, if you want a capital raise at the point of remortgage, i.e. raise some money to maybe pay off debts or whatever, again, that's where it's going to impact you. All other customers, they're still going to treat maximum working age at age 75, but for these specific people, they're capping it at 70, which, like I said, in my opinion, is putting up a barrier against those people who need most help. Aldermore have made improvements to their residential affordability. They now include 100% of overtime in their calculations and 75% of bonuses, 100% of nursing bank income, and 100% of universal credit, working tax credit, child tax credit, and disability living allowance. They also improved their income multipliers to 5.5 times if your income is above 60,000, and they've also made improvements to their self-employed criteria for those people with less than a 2-year trading history, increasing the maximum loan to value from 85% to 90%. So Aldermore really are looking to help people at the moment. And lastly, Metro this week have increased the loan to value limits. The maximum loan to value on 90% lending has now increased from 675,000 to almost double at 1.125 million, which is fantastic news. And at 85% loan to value, their maximum loan is now 2 million, not 1 million. So Metro really are looking to try and help people. Let's hope that more and more lenders in these difficult times start to look at ways that they can help more clients rather than discriminate against clients. So next up, we're going to look at the latest mortgage and arrears data from the Bank of England, which covers Q4 of 2023. Now, before I get into this and cover off the key points, this week we were asked by the press for our comments, which appeared in both the Daily Express and the Evening Standard. If we just scroll down for the Daily Express, you can see our comments appear here. People are genuinely struggling to afford their significantly increased mortgage payments. And then in the Evening Standard, again, this report clearly demonstrates the real struggles being faced in the mortgage market right now. So if we go back to the report, and I will put a link to this below so that you can take a look at it because there is a lot of information to go through. The key points are that the value of outstanding mortgage balances with arrears has increased by 9.2% from the previous quarter to 20.3 billion, and it's 50.3% higher than it was a year ago. The proportion of the total loan balances with arrears relative to all outstanding mortgage balances increased on the quarter from 1.12% to 1.23%. Whilst this seems small, this is actually the highest increase since Q4 of 2016. The value of new mortgage commitments, that's lending that's been agreed but not yet completed on, has decreased by 6.6% from the previous quarter to 46 billion, and it was 21.2% lower than a year ago, which clearly shows the struggles in actually obtaining a mortgage right now. Now, if we exclude COVID, this number is the lowest observed since Q1 of 2013, so over 10 years ago. New arrears cases decreased by 2.6% from the previous quarter to 13.2% of the total outstanding balances with arrears, but it remained 0.2% higher than it was a year ago. So tell me, if you've got a mortgage, have you recently remortgaged onto a higher rate, or is your mortgage renewal coming up and you're going to have to remortgage onto a higher rate? And is this something that worries you? Please do let me know your thoughts in the comments below, because I'd be interested to get a snapshot of what people are actually feeling about their upcoming remortgage or the remortgage that they've just done. So next, I'd like to take a look at the Office for National Statistics UK GDP report for January 2024. Again, link to the article below so you can go and take a read of this. I'm just going to cover off the main points. But the report shows that the economy rebounded in January with modest monthly growth of 0.2% after falling into a technical recession in the second half of 2023. But real GDP is estimated to have fallen by 0.1% in the 3 months to January 24, compared with the 3 months to October 23. Both services and construction registered most of the gains, up by 0.2% and 1.1% respectively. The one thing that weighed on the growth was strike action by junior doctors, contributing to the highest number of days lost to industrial action since September of last year. But we aren't out of the woods yet. Interest rate hikes are still feeding through into the economy, so we are going to have to keep a close eye on because the numbers could change in the coming months. The labour market is cooling, and inflation data due out next week should show a sharp slowdown, indicating that the Bank of England will begin cutting rates later this year with a suspected 4 quarter-point cuts. Now, when those rate cuts are going to start is everybody's guess. Some people are saying August and some people are saying sooner. Who knows? But the minute we find out, we'll let you know. But on that point, I would be interested to know what you think. Will the Bank of England cut rates this year? Will they put them up? And when is the first move going to be made? Please do let me know your thoughts in the comments below. And so let's move on to the RICS Residential Market Survey. So RICS are the Royal Institute of Chartered Surveyors, and their professional representatives all contribute to this report, which covers the whole of the UK and gives a real snapshot of what is actually going on in the UK residential sales and lettings market. This survey is used by the government, the Bank of England and other key institutions, including the International Monetary Fund, as an indicator of current and future conditions in the UK residential sales and lettings market. It is covered extensively in the media and is the leading source of market intelligence, highly regarded by both investors and across the industry. We scroll down a little bit, you can see that Goldman Sachs say this is the best short-term lead indicator of house prices and activity, and the Financial Times say it's one of the most reliable guides to the movement in house prices. So there will be a link to this article below, and when you get on there, if you just want to click on this here, the February 2024 UK Residential Market Survey, you can open the actual document and then you can have a read of it yourself. I'm just going to cover off the key points. And so the survey shows that green shoots are starting to show as buyer inquiries and property listings are on the rise alongside house prices, which are stabilising. The survey highlighted a positive trend in buyer interest of plus 6% across the UK for a second consecutive month, suggesting that the market is starting to recover. Despite a 3% dip in sales agreed in February, which was probably due to the increasing interest rates that we were seeing from lenders, it does indicate better numbers than the minus 22% observed over the last 12 months. The future is looking brighter, with 42% of respondents anticipating that an upturn in activity will happen over the next 12 months across the whole of the UK. And they also point out that there has been a marked increase in new instructions to sell, which is possibly caused by the improved sentiment that we're starting to see, but also because some people might be forced to sell due to these higher interest rates and they might be wanting to downsize. But instructions to sell is now at its highest since October 2020. House prices still do continue their slight downward trend across the UK, around about 10% per annum, but they do seem to be stabilising and do seem to be a long way off the 35% drop that some people have been suggesting might happen. So how are you finding the market? Have you been considering purchasing? Are you moving or selling and have maybe put your plans on hold, or are you now ready to take the plunge because you feel that things are starting to improve slowly? Or is the confusion about the interest rates and what the Bank of England are going to still making you sit on the fence and just watch this space for a while? Please do let me know your thoughts in the comments, just because I'd like to take a quick barometer of what people are generally feeling on the ground. So next up, let's take a look at the latest swap rate chart from yesterday evening. As you can see on screen, we take a look at the top section here first and foremost. These green arrows pointing upwards are not a good sign, because that means that swap rates increased on the close of business from the previous day, so they've gone up a little bit from Wednesday. Overall, the trajectory on the chart is still showing a slight downward direction, which is good news. But then if we scroll down slightly, so if we just take a look at the 2-year and the 5-year columns in particular, so 14th of March, you can see that they are still slightly lower than they were back on the 29th of March, but they're higher than they were back on the 31st of January or even at the end of last year. So swap rates have gone up a bit, which is a bit of a worry. Now, we think that one of the reasons behind this is because Andrew Bailey is consistently talking about when the Bank of England are going to start to decrease rates, and he does keep saying we're going to have to keep them higher for longer. We also know that he follows in America, and there's a general feeling that he's not going to want to reduce rates in the UK before the Fed do in the US. Seeing that the data in the US is not great and they're having to keep their rates higher, it's having an impact on the market over here. Hence, we're seeing the swap rates increase, and hence we're seeing the lenders' rates increase. There are also other reasons why lenders' rates are increasing, and it's all to do with hedging and being able to buy money at different rates so that the lenders can continue to offer fixed rate products to the clients. But this is partially why we're also starting to see the lenders' rates increasing, because their funds are starting to run out. Now, not all lenders actually borrow money from the money markets to lend. Some of them lend from their own book. But that just gives you a little bit of an idea as to why there's so much turmoil in the market, and it's because there really is a lot of uncertainty about when that first rate cut is going to happen. But please let me know what your thoughts are. I know some viewers think that the Bank of England are going to put rates up. I don't think that personally, but everyone's entitled to their own opinion. Do you think that they're going to cut rates? When are they going to cut rates? How much are they going to cut rates by? Or if they put them up, how much are they going to put them up by? Please let me know your thoughts in the comments. I love interacting with you guys. So if you're still here, thanks for watching, because there was a huge amount of information to cover in this week's episode. I hope you found it useful. If you're not already subscribed, please do consider subscribing and supporting the channel. It really does help. As I said previously, the purpose of this channel is to try and bring together all of the key news and information from the UK mortgage and property market from the previous week into one place, so that you get an idea of what's going on the ground. And if you do need to make any decisions soon, then you can make in a bit more of an informed way. As you know, this video is produced every Friday, the weekly news update. We do produce daily content on other social media channels, so why not go find us on Instagram, for example, at LodestoneMP, and you can find hot, off-the-press, day-to-day news as it happens. As always, thanks for watching. I hope you have a great weekend, and I'll see you next Friday. Take care.